Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to the 8th chapter in our series covering the changes enacted by the Tax Cuts and Jobs Act of 2017. This chapter will cover other income items along with Section 529 plans and ABLE accounts. The first item we will discuss is alimony. The current law states that any alimony paid is considered income for the person that receives the alimony and considered a deduction for the person that pays it. For any divorce or separation agreements that were in effect before the end of 2018, this is still how you will treat it on your tax return. However, the new law changes this for all divorce and separation agreements executed after 2018. The payments are no longer taxable for the payee, and there is no longer a deduction for the payor. Now I want to stress that this is only for new divorce decrees or separation agreements executed after 2018. If you are receiving or paying alimony payments under a previous agreement, then you treat the payments the same as you always have. The next item is moving expenses. Beginning in 2018, any reimbursements for moving expense will be included in your income. And with the new law, you can no longer claim any deductions. The only exception to this is for members of the armed forces that are moving because of military orders. Next is employment achievement awards that you may receive from your employer, such as length of service or safety awards. You can receive tangible personal property, such as a gift, valued up to $1,600 and it be excluded from your income. This is an increase from $400. Tangible personal property is basically any physical item, such as golf clubs or clothing. Now, tangible personal property does not include cash or cash equivalents, gift cards, gift coupons or gift certificates, vacations, meals or lodging, tickets to theater or sporting events, stocks, bonds, or other securities. There is one exception to this. If you receive a gift certificate that entitles you to choose an item from a catalog, it is considered as tangible personal property. On the flip side, if you receive one of the items that is on the not tangible property list, the value of the item must be included in your income. There are a couple of other items we would like to discuss. First is Section 529 plans. A Section 529 plan is a savings or investment account for education expenses. The benefit of such a plan is that any earnings from the investments are tax-free if the funds are used for qualified educational expenses. The purpose of these accounts when they were set up back in 1996 was to encourage families to save money for college. Contributions to these plans is not tax deductible, and there is no real defined limit on how much you can contribute on an annual basis. However, there is an aggregate limit to consider. You cannot have total contributions that would exceed the amount necessary to provide for the education expenses. In other words, if it will cost a total of $100,000 for your child to go to college, we wish, then you cannot contribute more than that to the 529 plan. This is basically controlled through the distribution process. Another limit to consider is that contributions to 529 plans is considered a gift to the beneficiary of the plan. Therefore, if you contribute beyond the annual gift tax limit, which is $15,000 for 2018 and 2019, then there may be gift tax issues to consider. However, there is the 5-year election that you can use. If you make a large lump sum contribution to a 529 plan in excess of $15,000, then you can elect to treat the contribution as if it was given over the next 5 years. With this provision, you can give up to $75,000 as a lump sum contribution without having any issues with gift tax, as it will be considered that you gave the $15,000 each year for the next 5 years. Keep in mind that you cannot give any other gifts to that person for the next 5 years, as you will have already given your gift tax exclusion. The distributions from a 529 plan are tax-free if they are used for educational expenses while attending a qualified institution. A qualified institution is generally any college, university, vocational school, or other post-secondary education institution eligible to participate in the student aid administration by the U.S. Department of Education. Educational expenses include tuition and fees, room and board, books and supplies, any school-related special services, and computer costs. The new law allows you to use distributions up to $10,000 for elementary or high school tuitions. This new allowance for elementary or high school is only allowed for tuition, not any other school expenses. The elementary or high school can be public, private, or religious. The new law also allows you to roll over funds from a Section 529 plan to an ABLE account up to the annual ABLE contribution limit. We will discuss ABLE accounts next. An ABLE, or Achieving a Better Life Experience account, is a tax-advantaged savings account available to individuals diagnosed with significant disabilities before age 26. Once diagnosed, you can establish an ABLE account and receive its benefits for the remainder of their life. The benefits of an ABLE account are that the earnings of the account are considered tax-free if used for qualified disability expenses. Qualified disability expenses are broadly defined as expenses as a result of living a life with disabilities. These may include education, housing, transportation, employment training and support, assistive technology, personal support services, healthcare expenses, financial management and administrative services, and other expenses which help improve health, independence, and/or quality of life. The tax-free earnings are great, but the main benefit of the ABLE account is that the value of the account, up to $100,000, is not considered when calculating eligibility for supplemental security income, Medicaid, or other public benefits. As we know, these public assistance programs have very limited asset guidelines. This allows you to retain some resources without losing these benefits. Contributions to an ABLE account are not tax deductible, and the new law has increased the annual contribution limit to $15,000. As we mentioned before, the new law allows you to roll over money from a 529 plan to an ABLE account up to the annual ABLE contribution limit of $15,000. This may be beneficial, as you may have been building up a 529 plan for your child's college, but subsequently the child was diagnosed with a disability. This way you can move the funds to provide for their needs. Thank you for watching this chapter and covering changes in income and a couple of other items. We greatly appreciate your time. Next time, we will cover the new tax rates. See you next time. Thank you. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com www.enacted.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.